It wasn't a trading error, it wasn't a liquidity hedge, it wasn't even a standard profit-taking maneuver. It was a geopolitical signal flare when an industrial superpower suddenly reverses course. When a nation that consumes more silver than any other entity on Earth begins to dump inventory, you have to look past the spot price, you have to look past the daily charts. The arithmetic is merciless. The pattern is unmistakable. We are witnessing a classic liquidation cycle. A maneuver that empires utilize when the cost of maintaining their internal stability exceeds the value of their reserves. China's recent export of nearly 660 tons of silver in a single month is not an isolated market event, it is a structural symptom. It marks the transition from accumulation to mobilization. To understand why Beijing would flood the market with a strategic metal it desperately needs for solar panels, you cannot listen to the central bank press releases. You cannot rely on the sanitized reports from the Shanghai Gold Exchange. You must look at the historical ledger, you must look at the mechanics of imperial resource management, because this has happened before. The incentive is always the same. When a state faces a wall of debt and a slowing engine, it liquidates the physical to sustain the financial until it can't, and then it locks the gates. History provides us with a clear roadmap of this exact sequence. We have seen this specific pivot 3 times in the last 2,000 years. We saw it in the silver mines of the Spanish Empire, we saw it in the debasement foundries of Rome, and we saw it in the desperate alloy adjustments of the British Empire. In every single instance, the dumping of silver was not the end of the crisis, it was the opening bell of the final phase, the phase where the currency fractures and the real assets are seized. The pattern is consistent, the outcome is mathematical, and the timeline is accelerating. Let us examine the evidence. To understand the gravity of a 660-ton liquidation, we must first understand the most significant silver distortion in human history. We must look to the Spanish Empire in the 16th century. This is the definitive case study of how an abundance of silver mismanaged by the state leads not to prosperity, but to a hollowed-out economy and an eventual collapse. The year is 1545. The location is Potosi in what is now Bolivia. A local, Diego Gualpa, discovers the richest silver deposit the world has ever known. Cerro Rico, the rich hill for the Spanish crown. This was not just a mine. It was a seemingly infinite line of credit. Under the rule of Philip II, the extraction process was industrialized on a scale that defies modern comprehension. They utilized the mercury amalgamation process, a toxic, labor-intensive method that allowed them to extract silver from lower-grade ores with terrifying efficiency. Galleon after galleon crossed the Atlantic. The Flota de Indias carrying hundreds of tons of silver coinage and bullion into the port of Seville. The arithmetic seemed perfect. Spain had the money, therefore Spain had the power. But the incentive structure created a fatal paradox. Because silver was so easy to acquire, the Spanish crown saw no need to develop domestic industry. It was cheaper to buy cloth from England. It was easier to buy grain from France. It was faster to purchase weapons from the Low Countries. The influx of silver destroyed the domestic production capacity of the empire. This is the phenomenon known as the price revolution between 1550 and 1600. Price levels in Europe, driven by Spanish silver, rose by roughly 300 to 400%. That might sound manageable over 50 years, but for a peasant population living on fixed customary wages, it was catastrophic. The cost of wheat exploded, land rents skyrocketed. The middle class was priced out of existence, replaced by a thin layer of ultra-wealthy merchants and a massive underclass of laborers. But here is the critical moment that mirrors our present situation. The dumping phase. Despite owning the mines of Potosi, despite the annual treasure fleets, the Spanish crown was perpetually broke. Philip II declared state bankruptcy 4 times during his reign: 1557, 1560, 1575, 1596. Why? Because the cost of imperial maintenance, the wars in Flanders, the Armada against England, the bureaucracy in Madrid always outpaced the extraction rate. When the pressure mounted, Spain did exactly what we are seeing today. They liquidated their reserves to pay foreign creditors. They dumped silver onto the European market to settle immediate war debts, suppressing the value of their own primary asset. They flooded the continent with coins, driving inflation higher, which in turn increased the cost of their own armies. The less it was worth, the more they had to dump. By the early 17th century, the flow began to dry up. The mines became harder to work. The indigenous labor force was exhausted, and Spain was left with no industry, a devalued currency, and a hollow empire. The flight to hard assets during this period was absolute. The lesson from Spain is clear: possession of the resource is not enough. If the state uses the resource to plug a fiscal hole rather than build productive capacity, the result is a collapse in purchasing power. Just like the Spanish Empire, the Roman Empire faced a similar mathematical wall, but where Spain suffered from too much silver, Rome suffered from a desperate need to stretch what little they had. This brings us to the crisis of the 3rd century. The mechanism here was not export but internal dumping through debasement. The Roman economy was built on the silver denarius. In the time of Augustus, this coin was roughly 95 to 98% pure silver. It was the reserve currency of the known world. It paid the legions, it bought the grain from Egypt, it settled trade with India. But as the empire ceased to expand, the plunder stopped. The costs of the border garrisons, however, did not stop. The state faced a binary choice: cut spending and risk a military coup, or fake the money. The incentive structure made the decision inevitable, starting under Nero and accelerating rapidly under emperors like Septimius Severus and Caracalla. The silver content was shaved 90%, 80%, 50%. By the time we reached the mid-3rd century, under the reign of Gallienus and Claudius Gothicus, the silver denarius was a copper coin. Washed in a thin layer of silver, it contained less than 5% actual silver. This was a dump of a different kind. The state was dumping base metal into the hands of the public while hoarding the high-purity bullion for itself, or for critical foreign bribes. The reaction of the market was instantaneous and brutal. Gresham's law took hold: bad money drives out good. Citizens realized the new coins were worthless. They immediately hoarded the older, heavier, purer silver coins. The real silver vanished from circulation. It went into clay pots buried under olive groves. It went into jewelry. It went anywhere except the marketplace. The state responded with force. They mandated price controls. The Edict on Maximum Prices, issued by Diocletian in 301 AD, is the most famous example. It set strict price caps on over 1,000 goods. Wheat, beer, shoes, labor. The penalty for violation was death. The result? The economy froze. Merchants refused to sell goods at the official price because it was below their cost of production. Goods disappeared from the shelves. Trade moved entirely to the black market. The urban economy of Rome collapsed. People fled the cities, moving to the countryside to work on large fortified estates known as latifundia. This was the end of the Roman middle class. They became serfs tied to the land, paid in food and protection rather than currency. The dumping of the silver standard was the precursor to the feudal system. The state tried to cheat the arithmetic. The arithmetic broke the state, just like the Roman experience. The British Empire in the 20th century offers the most modern and terrifying parallel to the current situation. This is the story of a managed decline that spun out of control. In 1914, the British sovereign was the gold standard. Sterling was as good as gold, but World War I shattered the ledger. Britain emerged from the war with massive debts to the United States and a broken industrial base. They attempted to return to the gold standard in 1925 at the pre-war parity. It was a mathematical impossibility. It caused a deflationary depression in British industry, but the silver story is where the true signal lies. Prior to 1920, British silver coins, shillings, florins, half-crowns were struck in sterling silver 92.5% pure. In 1920, facing a liquidity crisis and high silver prices, the government debased the coinage. They reduced the purity to 50%. This was the first dump. They extracted the excess silver to pay down war debts and manage the balance of payments, but the crisis did not end. World War II arrived. The costs were exponential. Britain sold its foreign assets. It borrowed heavily. And by 1947, the empire was effectively bankrupt. The government needed every ounce of silver it could find to repay bullion lent by the United States during the war, so they initiated the final dump. They eliminated silver from the coinage entirely. From 1947 onward, British silver coins were made of cupronickel. It borrowed heavily, and by 1947, the empire was effectively bankrupt. The government needed every ounce of silver it could find to repay bullion lent by the United States during the war, so they initiated the final dump. They eliminated silver from the coinage entirely from 1947 onward. British silver coins were made of cupronickel base metal. The government recalled the silver coinage, melted it down, and shipped the bullion overseas to settle the national ledger. Think about the experience of the average British saver during this period. In 1914, a bag of coins under the floorboards was a store of value. It was physical wealth. By 1947, the government had systematically stripped the value out of the currency, replacing it with tokens. The purchasing power of the pound collapsed. From 1945 to 1975, the British pound lost over 80% of its purchasing power. Those who held paper assets or government bonds were decimated by inflation. That peaked in the 1970s. Those who recognized the dump in 1947 and moved into physical assets, into gold, into land, or into foreign equities, preserved their capital. The transition from a silver standard to a fiat standard was not a modernization, it was a default, it was a confiscation of wealth disguised. As monetary policy, the pattern repeats in 7 distinct stages. Stage 1 is financialization. The empire enjoys a period of dominance. The currency is strong, the focus shifts from producing goods to producing debt. The financial sector grows larger than the industrial sector. Stage 2 is overextension. The state commits to obligations it cannot mathematically sustain: wars, social programs, bureaucracy. The budget deficit becomes a permanent feature. Stage 3 is the resource peak. The cost of acquiring the raw materials needed to sustain the empire begins to rise. The easy-to-access resources are gone. Returns on investment diminish. Stage 4 is debasement. The state begins to dilute the currency to pay its bills. In Rome, it was clipping coins. In Britain, it was reducing purity. In the modern era, it is quantitative easing. Stage 5 is the liquidation, the dump. This is the critical signal. The state, facing a crunch, begins to sell off its strategic reserves. It sells gold, it sells silver, it sells oil from the strategic petroleum reserve. It does this to suppress prices and create the illusion of stability. It is a desperate attempt to keep the system liquid. Stage 6 is scarcity and panic. The dumping depletes the stockpile. The market realizes the cupboard is bare. Prices violently reverse. The asset that was dumped suddenly becomes unobtainable. Trust in the state's ability to manage the price collapses. Stage 7 is the reset. The currency fails or is redenominated. A new system is introduced, usually backed by whatever hard assets remain or by draconian capital controls. Just like the British Empire in 1947, we are currently watching Stage 5 play out in real time. Current data suggests we are witnessing a strategic liquidation event. The headline is that China exported roughly 660 tons of silver in December. This was a massive reversal. For years, China has been a net importer. They dominate the global solar panel industry. Photovoltaic production requires massive amounts of silver paste. China controls over 80% of the solar supply chain. Logic dictates they should be hoarding every ounce, so why dump it? Why flood the global market when industrial demand is projected to outstrip supply? The arithmetic points to a liquidity crunch. The Chinese property sector is in a slow-motion collapse. Local government debt is straining the banking system. The yield spread between the US dollar and the yuan has put immense pressure on their currency. Under these constraints, the rational move for the state is to mobilize assets. They are liquidating silver to generate immediate dollar liquidity. They are managing the exchange rate, but there is a darker interpretation. Some economic historians argue that this is a price suppression operation. By dumping silver, they keep the internal cost of manufacturing solar panels low. They crush the global spot price temporarily to bankrupt Western mines that have higher operating costs. It is a form of economic warfare. Burn the inventory to secure the monopoly. However, the risk is asymmetric. Global silver deficits are already structural. The Silver Institute estimates that demand has outpaced supply for 3 consecutive years. Mines are aging or grades are falling. By dumping 660 tons, China is tightening the spring. They are selling physical metal into a market that is already in a deficit. When this liquidation selling stops, and it must stop because physical reserves are finite, the suppression ends. The counterargument is often made that this is simply a trade imbalance correction. Analysts will say that China simply overbought in previous months and is rebalancing inventory. They will argue that industrial demand is softening, but this ignores the monetary role of the metal. Central banks globally are buying gold at a record pace. Silver is the poor man's gold. When the gold-to-silver ratio is this high and a major power starts dumping physical inventory, it suggests distress, not optimization. If it were a simple rebalance, it would be done quietly. A surge of this magnitude is a scramble for cash. It signals that the internal financial pressure in the East is greater than the external industrial demand we are approaching. The endgame's history suggests three potential outcomes. The first is controlled decline. This is the British model, a slow, painful erosion of living standards. The currency loses value year over year. The state manages the price of silver and gold through regulation and taxes, making it hard for the average citizen to participate. The wealth transfer is gradual but total. The second is chaotic collapse. This is the Weimar or Venezuelan model. The dumping fails to stop the bleeding. The currency enters a hyperinflationary spiral. The price of silver in local currency goes vertical. Supply chains break. The social contract dissolves. The third is reset and restructure. This is the most likely modern outcome. A new monetary framework is introduced. It may be a central bank digital currency CBDC linked to a basket of commodities. In this scenario, the dump was a way for the state to clear the deck before revaluing the assets. In 1933, the United States confiscated gold and then revalued it. In a reset scenario, the state may attempt to nationalize the strategic metal supply. They will declare silver a strategic industrial resource critical for national security energy transition. They will restrict private ownership or impose windfall taxes on sales. The dumping we see now is the state maximizing its position before changing the rules. The pattern is clear. The arithmetic is merciless. The only variable is timing and pain. If you understand this, you do not look at the spot price of silver as a trading signal. You look at it as a countdown. You do not prepare by speculating on leverage. You prepare by educating yourself on the history of money. You prepare by building resilience in your own supply chain. You prepare by understanding that when empires dump real assets for paper money, the end of the paper money is near. Subscribe to the channel, study the data, watch the flows, not the headlines.